Hey, what's going on, guys? Mr. Unemployable here, coming at you with a video for an introduction to Forex. Now, I know we have a lot of new students coming in to the Forex platform, and I'm beyond excited to see you guys here. It's going to be phenomenal to be able to see you guys grow from Forex and understand the power that Forex has and what it can give you in return in terms of freedom, money, and then just the ability to be able to do something that you actually want to do, which is be free. All right, so really quick, I'm going to go ahead into introduction to Forex. Really quick, what is Forex? All right, so Forex is short for foreign exchange market. All right, the foreign exchange market is a $5.3 trillion market. It is open 24 hours a day, 5 days a week, and it trades currencies from all over the world. And some of the bigger currencies, we're looking at euro. For example, here we have the euro, Japanese yen. There is the US dollar. There is the the Canadian dollar, CHF, that stands for the Swiss franc, GBP, Great Britain pound, AUD, the Australian dollar. So those are the big pairs that we trade. There's many, many more pairs. There's also exotic pairs like the Mexican peso and the Russian ruble and the Turkish lira, all of that stuff. So that's just an example of what Forex is. It's just an exchange of one currency to another. So I'll explain to you guys really quick the way Forex works. In the real world, Forex still works traditionally, right? You need to go and travel. For example, you need to go to Russia, okay? And you take an airplane from here to Russia, but you need some Russian rubles because they do not accept the US dollar. So right when you get to the airport, there's a little booth called currency exchange, all right? And all the time, you're gonna see the price of the currency fluctuate. Just like you see in it right here, it's currently changing up and down, up and down, up and down. So that's based on what's going on with the world economy, with that country's economy, what's going on for example, Russian economy or the U.S. economy, an example, right? So it's always fluctuating. So for example, looking at the U.S. dollar here versus the Canadian dollar. So you can see that the U.S. dollar dropped against the Canadian dollar, right? It's been coming down. And this is happening, this all today, it's happening today. All right, so that's what pretty much it entails. So let's say if you would have sold the dollar, that means you would have been buying Canadian dollar and you would have made profit on the way down. You will always see currencies being pairs. You will see US dollar Canada, Australian dollar Swiss franc, Canada Swiss franc, Canada Japanese yen, Swiss franc Japanese yen. And what that entails is pretty much that you're always buying and selling in every trade you get in. So for example, if you get into a trade here in the US dollar, Canadian dollar, and you go ahead and sell this currency up here, that indicates that you're selling the base pair, which is the US dollar, and the other currency, you're doing the opposite. So if you're selling US dollar, you're buying Canadian dollar. All right. And that indicates here that the US dollar, which is the major pair here, is coming down against the Canadian dollar. And that's exactly what happened. And if you call it right, you go ahead and make a nice little chunk of change, little profit. Okay. And that's how the Forex market works. All right. So it's pretty much just identifying a few things, a few patterns, price action patterns, fundamentals, which is news, anything that's going on in the news, maybe some unemployment changes or recessions or inflation, stuff like that. They will always impact, and the news will release them, and it will create big movements like this nice long movement to the down. So if you would have caught this for a sell up here and you would have sold it all the way down here, you would have made some money. This was actually last Friday, and I caught this trade at 8:29 a.m. The news will release at 8:30 and caught it until right about here, and I closed out and made a nice little chunk of change. And that's what we look forward to do, all right? Now, pretty much basics is this. Every trade is always going to be at least a 50% chance of getting in the right time, getting out at the wrong time, all right? Now, really quick, I pulled this up. I never have this up here just because of the sake that I can't show you the way it looks on the trading platform that's on my phone. So here is how it will look like, right? We have the USD CAD, okay? And this is the price that we're getting in if we're going for a sell. And this is the price we're getting in if we're going for a buy, okay? So if you're buying, basically, if you're buying, that means that one US dollar will get you 1.34 Canadian dollars and vice versa. All right, this little number you see in the middle, that's called the spread. Now the spread is pretty much what you pay to get into the trade. And every number is calculated, every amount of pretty much any amount of to determine how much we win and how much we lose is calculated in pips, not just in dollar signs and how much money, but also point in percentage, all right, which is called a pip. Now, a pip would be the fourth number here, okay? And if it goes up, that's 1 pip. If it goes up, it's 2 pips, okay? And here we see the spread. Now, the spread here is 2.6 pips. So that means that if you're going for a buy, you're automatically going to start negative 2.6 pips, all right? Just because that's what you pay to get into the trade. It's this difference between the sell and the buy. If you were to subtract these two numbers, you will get 0.00026. What you do is put the decimal point in the right place, and you have a 2.6 spread, which is a 2.6 pip spread. All right. Now, Forex, guys, have been around forever. All right. Forex, we've always exchanged things. Remember back in years before our time, before our grandparents' time, currency used to be rice. It used to be spices. It used to be stones, coins. People would trade rice for some chicken, or chicken for a spice, or rice, things like that, you know. And then we moved on to heavy coins, gold coins, silver. Then we moved on to certificates, and then we moved on to dollar bills. And now we're currently standing at debit cards and credit cards. And now we're jumping into something big called Bitcoin, which is completely digital. All right, so we'll get into that later, but that's pretty much the basics of what Forex is. All right, now, quick things I wanted to go over, I wrote them right here, is what is a stop loss? Now, what is a stop loss? I'll give you guys an example. All right, a stop loss is pretty simple. So when we get into a trade, let's say we go ahead and take this trade right here. All right, and I want to get in for a buy on this trade. So right now we're in USD CAD, and I'm thinking it's going to turn around, it's going to reverse, so I'm going to go ahead and get in for a buy right here. All right, now the red zone is the area that I don't want the price to go to, and the green zone is my goal. All right, so I'm going to predict that the price is going to go from here all the way up here, and my stop loss is going to be around down here. Now, the stop loss is the end of this red zone. Now, what is a stop loss? Let's say price does not cooperate and it doesn't go up direction I want it to. It actually comes down, all right? And it comes down past my stop loss. Now, what happens is this. Once price touches that price of right here, my stop loss, I'm automatically exited from the trade, preventing me from losing money, which is kind of like a stop the bleeding situation, you know? If you trade with no stop loss and the price goes up and keeps going down, it will not stop until your entire account is at $0. All right, it will keep going, and take as much money as you possibly allow it to, which is why we always trade with stop losses, all right? And a take profit is just the complete opposite. Take profit is that goal, that zone that we have. So I said I think it's going to come up here, and if price goes up and touches here, once price touches that zone, I am automatically exited from the market, and I take my profits with me. If I'm exited at the stop loss, I'm out of the market with my loss. All right, so I'd rather lose $50 than lose the entire account, or an etc., maybe $5 or $100, depending on what you risk. All right, we'll go over risk management in further videos. But that's pretty much what a stop loss and a take profit is, all right? It's just the goal. Pretty much the stop loss is the safety net, and the take profit is the goal of where we see, and we want to make sure we exit the market at the right time. There's always going to be a right time and a wrong time to enter and exit the market. We just have to determine which one is which, okay? And that's it for now, guys. So I'm going to go ahead and make another video. Make sure you take notes. If you have any questions, get back to me. And that's it for this one.